Welcome to The Explainer. Okay, today we're diving into a genuinely fascinating and honestly really balanced investment case for 2025. We're looking at one of China's absolute premier financial institutions, China Merchants Bank, or CMB. I absolutely love looking at companies that sit right at the intersection of traditional stability and rapid innovation. And well, that is exactly where CMB finds itself today. We're going to strip away the noise and look directly at the data to see exactly how this retail banking giant is maneuvering through some rather choppy economic waters. Okay, let's dive into this roadmap. Think of this as your fund manager-style briefing where we just objectively weigh the risks and rewards. We're covering navigating the macro storm, a fortress balance sheet, the fintech and wealth pivot, price versus real value, weighing the bear case, and finally, the bull case verdict. So here's the ultimate riddle for literally any financial institution. How exactly does a bank grow when interest rates hit rock bottom? Keep this question in the back of your mind as we go. It's really the core tension of our entire narrative today. Traditional banking relies heavily on the spread between borrowing and lending. So, when rates vanish, the old playbook basically goes right out the window. So how is CMB rewriting that playbook? Section 1. Navigating the macro storm, surviving a low-rate world. Now, what's really interesting about this slide is the stark contrast. We've got to acknowledge right out of the gate that China's banking sector is under immense structural pressure right now. To understand the reality of that tough environment, just look at the net interest margin, or NIM, basically the lifeblood metric of a traditional bank. The industry average in China has compressed down to a historic low of just 1.42%. But look at CMB, they're sitting pretty at 1.87%. Not only does this beat their peers handily, but their NIM actually improved sequentially in the fourth quarter. What you should take away from this is that CMB's liability management and their sheer pricing power remain absolutely best in class, even when the macroeconomic wind is blowing right in their face. Section 2. A fortress balance sheet, the protagonist's armor. You literally can't weather a macro storm without a sturdy ship, right? Well, the crucial proof of CMB's armor is right here. RMB 150.2 billion. That is their massive net profit for 2025. After seeing a slight dip in 2024, their revenue and profit have confidently turned positive again. This isn't just treading water, folks. This is a massive return to growth. The growth engine is officially firing again. And quickly, you really have to appreciate the sheer magnitude we're dealing with here. Total assets have now surpassed an eye-watering RMB 13 trillion. Backing that up is a net operating income that reached RMB 337 billion. Now, while their net interest income grew a modest 2.04%, that massive asset base is providing a foundational bedrock that very few competitors can match. And honestly, this number brilliantly illustrates what a true fortress balance sheet actually looks like, a 391% provision coverage ratio. To put that into perspective, for every single bad loan they have nearly 4 times the cash set aside to cover it. Couple that with a remarkably tiny 0.94% non-performing loan ratio, which, by the way, actually improved, and you see an asset quality that is just rock solid. They are playing fantastic defense. Section 3. The fintech and wealth pivot beyond traditional banking. But, playing defense just isn't enough to thrive. Management is actively and somewhat radically repositioning CMB for the future, and these are the 3 pillars of that mutation. First up, they threw down more than RMB $12.9 billion in tech investments last year alone, deploying AI across over 800 different scenarios. Second, they're venturing into digital assets to capture global liquidity. And third, they are showing massive ESG leadership with a pristine AAA MSCI rating. That rating is like catnip for international capital that requires strict sustainability metrics. And the best part? It's working. Remember earlier we said net interest income only grew 2%? Well, their fee income from wealth management surged nearly 17%. They aren't just a bank anymore. They're essentially a fintech and wealth platform. And decoding this digital push reveals something pretty surprising. Look right here at how CMB International, their Hong Kong arm, actually tokenized a $3.8 billion money market fund on the BNB chain. This is a pioneering, highly forward-looking move to digitize real-world assets and seamlessly tap into global liquidity pools. They are looking way, way beyond traditional borders. Section 4. Price versus real value, the valuation opportunity. So with all this growth and innovation, we know it's a stellar company. But is it a great stock? Let's break down these metrics. Currently, CMB's Shanghai-listed shares are trading at a price-to-book ratio of roughly 0.83 and a price-to-earnings ratio of about 6.6. But look at the bottom line there. Analysts have pinned a fair value estimate on this stock at around CNY 52.80 per share. The huge disconnect between that low PB ratio and the analyst's fair value estimate suggests there is a very notable upside here. But perhaps the absolute most compelling part of this whole valuation story is this. Right here, CMB's offering an approximate 5.1% dividend yield. And notice they've maintained this dividend payout ratio above 35% of their earnings for 3 straight years now. In a low-yield macro world, securing a 5.1% income stream from a best-in-class institution, that's highly attractive. Section 5. Weighing the bear case. What could go wrong? Okay, let's pivot objectively here, because a stock doesn't just trade below book value without the market being incredibly wary. What are the fears? First up, NIM pressure. Yes, CMB is absolutely outperforming its peers, but their NIM is still in a broader decline. If China cuts interest rates further, that core lending business gets squeezed even tighter. 2. Market volatility. Capital market swings recently caused a drop in their other net income, proving their trading books definitely aren't immune to sudden market shocks. And 3. Economic exposure. Despite that stellar 0.94% NPL ratio today, any sharp downturn in China's property or consumer sectors is going to ripple right into CMB's retail and corporate portfolios. Section 6. The bull case verdict. Why own it? Okay, the risks are very real for sure, but let's physically weigh the scales here to see the offensive potential. On one side, the fears, margin squeezes, market swings, and economic exposure, but on the other, the facts offsetting them. You're buying a best-in-class retail bank at a discount. You have an incredible RMB 17 trillion with a T, in wealth management assets under management, giving you huge exposure to a rapidly growing market. And you're backed by a management team deploying serious tech to drive non-interest income. I absolutely love this summary quote from the source presentation. Quality is clear, price is attractive, risks are manageable. It perfectly sums it up. For long-term investors, the current price offers a genuine margin of safety. You're getting paid a very healthy dividend just to wait out the economic cycle. And for the shorter-term traders tuning in, the volatility around those interest rates might actually create some very compelling entry points. Which leaves us with this final lingering thought. With a 5.1% yield, are you willing to wait out the cycle? As you ponder that, consider what we might see next. How heavily will future rate cuts impact their NIM? And how will regulators view their pioneering crypto and tokenization initiatives on the BNB chain? CMB is navigating a highly complex environment with incredible skill, and their next steps will definitely be worth watching. Thanks for joining me on this explainer, and keep learning.